Hi, welcome to this video today, which is all about Forex trading for beginners, learning Forex trading the right way and basically becoming a profitable and successful trader. And in relation to this, I want to go through 10 mistakes. Now, in terms of these mistakes, beginners, any beginner is going to make at least one of them, probably several, or maybe all of them. Make one of these mistakes for long enough, and that will ensure you're in the 90% of losers. Now, in relation to this, legendary trader Jim Rogers once said that most commonly accepted wisdom about trading is misconception. It is. And beginners actually, when they come in the markets, they do trading in what they consider to be a logical way. In many instances, it makes them feel comfortable with what they're doing and what makes them feel good about themselves. And it just basically sees them wipe out their accounts. If you get into a comfort zone in Forex trading, and you'll see what I mean by this in a moment, you are going to lose money. It's not about feeling comfortable. It's about doing the right things, okay? Now, in relation to the 10 mistakes and avoiding them, I'm just going to summarize them on a quick storyboard and go through them, okay? So let's just take a look at them and see why you need to avoid these 10 key errors. Right, let's have a look at the 10 key beginners' mistakes. They're in no order of importance. They're all very important in terms of avoiding them. Let's take the first one. Nothing makes traders feel more comfortable when they first start trading the markets than technology. Very often when you see educators online, so-called traders, they're surrounded by banks of computers and talking about how their strategies work. They're normally set strategies, without human input. Get a lot of people saying that mechanical trading systems work. There's a mathematical formula to the markets. There isn't. Nassim Taleb, in his award-winning book, The Black Swan, which I recommend any trader go and read, says you can just prove anything with mathematics in any field you like, But you can prove order going backwards. But when you're in the real world, it's chaotic. And a lot of traders can test methods going backwards, and they appear to work. There's a reason for that, because they can basically bend the strategy to fit the past data. But future data never repeats in the same way, and the strategy will break down. Technology is convenience, okay? It's not a route to Forex trading success. You actually have to trade and think, okay? Which a lot of traders don't want to do. Point number 2, the cult of the expert, dailyfx.com. A lot of beginners want expert advice when they come in the Forex markets, okay? Dailyfx.com is probably one of the worst examples, of not the only one, of so-called experts, okay? Go to the site and all you get is, you get a lot of people there, the so-called analysts, the experts. They've all got really sort of grand names, a macroeconomic strategy expert or short-term trading algorithmic, okay? They're not experts at all. People are actually fooled by the fact they give themselves these titles. If you look at the analysis on the site, you never get a trade, okay? It's way too complicated, and it's all based around order. There's so many lines on their charts that just basically, price is bound to bounce off some of them or penetrate some of the levels, and they can say they're right in hindsight. Now keep in mind, the site is run by a broker, okay? Broker knows what the public wants. Dailyfx.com is hugely popular because of that, and there's many other sites like that. Also, when you look at experts talking, let's say on Bloomberg, CNBC and so forth, they make it look so easy trading. They just explain everything going backwards. They can't do it going forwards, okay? So you've got to get out of the idea that there's experts that can help you, okay? You can do it on your own, all right? Now, leading on from dailyfx.com, too many inputs to a strategy, order and hindsight bias. Too many lines on a chart through meaningless levels, okay? Then you've got this sort of cult of order that a lot of people promote online. I mention it frequently, but the most laughable trading strategy has got to be Gartley patterns. That all those peaks and troughs in the past mean something, and you can measure things mathematically. Putting it in perspective, Gartley never made any money with this strategy, yet a huge amount of people are attracted to it. It only works in hindsight. It doesn't work in the real world. Now, point number 4, working hard. That's comfortable for most people. Coming in the Forex markets, work hard, you're going to get your reward. Alas, that isn't true. Okay, you can look at the chart for a few seconds, which I would recommend, no longer than that, or you can look at the chart for an hour and mess around with it. That doesn't improve the probability of success. The person who looks at a chart quickly as a simple strategy or methodology is probably going to do better than the person who overthinks. If you overthink a chart, there's probably nothing to do. You just basically want to work hard and find something to do. Now, in terms of Forex trading, you've got to think about not working hard, okay? Make your decisions quickly and do not take many trades. You've got to keep in mind the 80-20 rule, which is called the Pareto principle. It's taught in business schools, and basically the principle is like this. Let's say your business, 80% of your sales are probably going to come from just 20% of your clients. So focus on the 20%, the smaller number that matters. Same in trading. If you come up with a lot of trades, slim them down, okay? Less is more, okay? Don't take trades for the sake of trading. The 80-20 rule, I strongly recommend anyone go and read it. It works in many areas of life. Less is more. You don't need many trades per month to make a lot of money. And in terms of working hard, a lot of traders go for day trading and scalping. Huge mistake. They're working hard. They want to sit in front of a screen. They want to get a regular income, and all they do is trade noise. You're not going to make money day trading or scalping. Okay, it's got high appeal, but you won't see anyone who actually promotes it as a way to make money ever give their trades. I've said on numerous occasions. Point number 5: probability, risk to reward, and profit. Another thing that makes traders feel very comfortable is getting what they consider to be a good risk-reward trade. So they basically say, "Oh, I'm risking $100, and I could make 500. So I've got 5-to-1 risk to reward." Some traders say maybe 100 to make 1,000, 10 1 risk to reward. That's not the risk reward of the trade. That's just an opinion. Okay, a lot of traders basically put their stops too close and then have outrageous profit targets. Normally, you should start off with risk to reward 2 or 3 to 1, and then see how it goes. Basically, the only thing you can guarantee in Forex trading is how much you're going to lose. You can guarantee that. You can't guarantee how much you're going to win. You've always got to keep in mind the probability of a trade is your subjective view. And it is comfortable to say, I'll risk 50 to make 1,000. But the reality is probably your stop's too close, your target's too far away, and you'll end up losing, okay? Point number 6, trading low volatility. I see this a lot online, actually. Don't trade highly volatile pairs, okay? Why would you not trade highly volatile pairs? They're moving. You trade low volatility, there's probably not much going on. You're just caught in the noise. You're probably going to be caught in a trade for too long. Your money isn't working hard because you're not making anything. It's pointless. You want high volatility. You want big moves. Doesn't matter if you stopped out. You get a result quickly. Okay? That's better than being in low volatility with low odds. Not getting a result quickly, and very often getting a loss after holding the trade for a while. Never be afraid of volatility. Point number 7, anchoring to entry and doing nothing. Common beginner's mistake. Doing nothing is very often the comfortable thing for traders to do when they've entered a trade. They think it's going against them, okay? But they won't come out. It's just easier to do nothing than to do something. Why is this? Because if they actually take out the losing trade, okay, it could turn around and become a profit. They also normally want it to come back to entry. You hear it a lot. When it gets back to entry, I'll come out. Stupid, okay? Doesn't matter. If it's red on your computer screen, if you bank the profit, bank the loss or not, it's still a loss. And traders anchoring to entry, it's got to be one of those common errors out. You should be decisive. If you've got a loss and you think it's going to run further, you don't hope it turns around. You get out. It's not the comfortable thing to do. It's the right thing to do. Point number 8, anchoring to past price to buy or sell back to. This is another really key beginner's mistake. Let's say you get a big trend, okay, developing, high volatility, prices are moving strongly. The trader, thinks, well, that price move is probably going to actually continue. But let's say it's going up. He won't buy it because he wants a better price. He's anchoring to the past, okay, a lower price. That is the comfortable entry to get the pullback. But very often, big trends simply don't pull back. The uncomfortable thing is to go in. Okay, you haven't got the perfect entry, and you could say that you've missed some profit, but you only know that now the prices move. But there could be a lot of profit ahead of you. Professional traders are used to getting into trends in motion, continuation. The beginner very often misses big moves because they're waiting in vain for the pullback. Point number 9, trading a small account and insignificant money. What I mean by this is a lot of traders just put in an amount that they really don't care about. It's insignificant money to them. So they don't really mind if they lose trades. They've got no sort of problem with it, okay? But it's a huge problem because, basically the money's insignificant and, you can lose it. It doesn't really matter to you what's going to happen. You're going to lose it because you won't focus on protecting your money. You won't consider it valuable. You won't, I've said it in previous videos, take good care of it. In terms of point number 10, the comfort of order. That's what traders want. That's what most beginners want. But the reality is randomness a lot of the time in Forex markets. But you can make money from randomness because while a lot of the movement is random, you can trade probability where you get the odds on your side and you can win. And I think, traders need to get out of that comfort zone. Most traders are uncomfortable with uncertainty. If you're uncomfortable with uncertainty, don't even bother trading Forex. It suits people who don't mind dealing with uncertainty. Anyone that can actually do it, you only need a simple strategy and the right attitude, and you can make money. Now, in terms of the beginners' errors I've listed out, I can almost guarantee that beginners will make one or all of them when they first start trading. But the point to keep in mind is if you do make any of these errors, okay, correct them straight away. And keep in mind that you can avoid these errors if you want to. If you avoid the errors, you could well be on the road to Forex trading success with a simple strategy and just having the right psychology and mindset to execute it with discipline. Right, that's the video for today. Thanks for watching me. Take care and have a good day.